Good evening, friends. This is Manish Khandelwal. I'm a mechanical engineer. My experience in short is mentioned at the bottom of this slide. You may also notice that the name of this channel is changed. It is Factory Forward TV. I have started one more channel named Brainy Builders. This channel focuses on science and mathematics subjects for children. New channel coupled with some other issues did not allow me any presentation on this channel last week, and I am extremely sorry for it. I am trying to compensate this delay by giving a presentation on a very interesting topic, that is gross profit margin. Friends, gross profit margin is not an engineering subject. This is a financial matrix. This measures the performance of a business by comparing the revenue it has earned to the cost of goods sold in percentage. One more similar term is gross profit. This also is very widely used in all the business entities. Let's understand the two terms and the difference between these two. So gross profit margin measures the performance of a business entity in percentage, whereas the gross profit measures the performance of a business entity in absolute term. This is what we just said. Then gross profit margin informs as to what percent of revenue the company has retained after subtracting cost of goods sold from revenue. We shall take one example also. I think things will be more clear then. In gross profit, this informs as to how much money is retained after reducing COGS from revenue. This formula is very important. Gross profit margin in percentage is equal to revenue the company has earned minus cost of goods sold into 100 divided by revenue. Whereas the gross profit is equal to simple revenue it has earned minus cost of goods sold. Then gross profit margin helps the management to view the effectiveness and efficiency of a business, whereas as we said before also provide information to management in absolute context, gross profit. Let's take one example to make things more clear. Suppose a company's revenue, the revenue is total amount of money a company received carrying out by sale. So a company's revenue and COGS is as under. Revenue in first year was 1000, COGS was 800, then the gross profit margin shall be as per this formula revenue minus COGS, that is 1000 minus 800 into 100 upon 1000, that is 20%. So we'll say the gross profit margin for the company was 20% in year 1, whereas the gross profit was simple revenue minus COGS, that is 1000 minus 800, that is rupees 200. In second year, suppose the revenue of the company is doubled, so it is rupees 2000 for year 2. The cost of goods sold for this year was 1700. Now gross profit margin for year 2 shall be 2000 minus 700 into 100 upon 2000. This will give you 15%. That means the gross profit margin of company has reduced from 20% to 15%. The gross profit shall be rupees 2000 minus 1700, that is rupees 300. Now, if you compare only the gross profit, it will give you a figure that okay, the company's profit has increased substantially from 200 to 300. But when you check the gross profit margin, then you will come to know, oh, the efficiency of the company has reduced. There may be some losses which have gone up. So Here it has come down from 20% to 15%. So this is the advantage of calculating gross profit margin. Let us understand few important terms, and the first is revenue. Revenue is earning inclusive of taxes by a company in a specified period. For example, a mobile manufacturing company has following data for a particular financial year. This is the data. They made mobile model A, B, C, D, E, F, G, H. The selling price for each model per piece is as mentioned here. The quantities sold per model is also mentioned here. The revenue collected shall be quantity sold multiplied by selling price of one piece. So this is the revenue they have collected. I am assuming that this is inclusive of all the taxes. This comes to 1872.75 lakhs. This is just an example. So the revenue earned by that company is 1872.75 lakhs. Mind it, earning other than regular business like rent, consultancy, interest, etc., if any, should not be added to calculate revenue for specific product or services. If we are calculating the revenue for the company for complete financial year, then all this earning shall be added to. But if we are focusing on, for example, we are focusing on only the mobile, that what was the gross profit margin, or what was the revenue earned by selling the mobile, then we shall not include the earnings, if any, from rent, consultancy or interest, etc. Next important term is cost of goods sold, also called COGS. In this, the cost of ordering of the material, cost of receipt of the material, then cost of inspection of the material, cost of manufacturing of the product from this material, and then the cost of packing and forwarding of the product. All that shall come in cost of goods sold. Even the cost of machine maintenance shall also come in cost of goods sold. There can be different methods of calculating COGS, and the cost coming out of these methods shall be different in majority of the cases. So first method is first in, first out, FIFO. In this, it is assumed that the material purchased first is used and sold first. For example, we have received 3 lots in a month, lot 1, 2 and 3. Then it is assumed that the material coming in lot 1 shall be used and sold first, then material in second, and then in third, in that order. The COGS is calculated as the cost of finished goods in the beginning plus the cost of goods manufactured minus the cost of finished good at the end. And the cost of goods manufactured is equal to total manufacturing cost, TMC, plus cost of work in process in the beginning minus the cost of work in process in the end. And the total manufacturing cost is direct labor cost plus direct material cost plus manufacturing overheads plus packing and transportation. We'll take one example to make things more clear. The other methods are LIFO. First was FIFO, this is LIFO, last in, first out. In this, the material purchased last is used and dispatched first. So for example, there are 3 lots coming 1, 2nd and 3. So we'll assume that the material coming in lot 3rd will be used and dispatched first. So this is LIFO. Third is WAM, weighted average method. In this, we calculate and use average cost of inventory. Suppose we purchase 3 lots at the rate rupees 5, 5 and 8, for example. Then the average price side shall be 5 plus 5 plus 8 divided by 3 is equal to 6. So we'll consider the cost of inventory as 6. And last is SIM, that is specific identification method. In this, we identify and assign the actual cost of inventory sold. That means if we have received these 3 lots, so whether we have used rupees 5,1 or we have used material which has come from rupees 8. So actual cost of inventory we shall be used. So let us understand one more term, that is cost of goods sold. We'll take one example and we'll calculate direct material cost on this slide. So data of a pen manufacturing company is as under. The first data is for number of pens at the beginning of the month, we had raw material for 500 pens at the rate rupees 45 per piece. There were total 550 pieces available in WIP, work in process, at rupees 65 per piece. So WIP cost was rupees 65 into 550, total 35,750. In FG there were 250 pieces available and cost per piece was rupees 80. So 80 into 250, rupees 20,000 is the FG cost at the beginning of the month. Second data was for number of pens at the end of the month. This was for the beginning of the month. This is for the end of the month. Raw material was available for 500 pens, but here the cost is rupees 50 per piece. I have shaded this area because the raw material available at the end of the month should not be considered when we calculate cost of goods sold. Now WIP was available for 500 pieces and here the cost was rupees 70 per piece. So total WIP cost was rupees 70 into 500, that is 35,000 piece. Similarly in FG there were 300 pieces available and per piece cost was rupees 85. So here the FG was available for rupees 25,500. Cost per piece mentioned for WIP and FG both at the beginning of the month and at the end of the month, we shall consider when we calculate COGM, that is cost of goods manufactured, and not here. The third data was for the purchase. We made purchase 2 times in that month and both the time we made purchase for 8,000 pens. First time we purchased material at the rate rupees 50 per piece and second time we purchased material at the rate rupees 55 per piece. Then we made dispatches 3 times to our customers. First on 10th, then on 21st and then on 30th. When we calculate the direct material cost following FIFO method, then of course we follow this way. Mind it, irrespective of FIFO or LIFO, we have to dispatch the available quantity in FG and WIP first. And also we have to use our raw material first. So what we will do here, we'll dispatch 550 plus 250 pieces from WIP and FG, totaling 800 numbers. We'll also use 500 raw material for 500 pieces at 45 rupees. So 500 into 45 plus remaining 2200. 800 plus 500 is 1300. We have to make dispatch of 3500. So 3500 minus 1300 is 2200. So 2200 we will take from this lot. 2200 into 550. Total will come 1,32,500. This will be the direct material cost. On 21st, we dispatched 7,500 pieces. So from this lot, we already have taken 2,200. How much have we left with? 8,000 minus 2,200 is 5,800. So 5800 into 50 we dispatched from this lot, plus we took 1700 from the fresh one. 1700 into 55, that is 3,83,500 was the direct material cost on 21st. On 30th we dispatched 5,000 pieces, and all these 5,000 pieces we took from last lot. So 5,000 into 55, 2,75,000. So the total direct material cost, if we add all these three, will come to 7,91,000 rupees. Now, if we follow LIFO method to calculate direct material cost, then for first dispatch on 10th, 3,500 numbers, as I said before also, we have to exhaust this quantity first. So 250 plus 550, 800 we dispatched here. And then of course raw material for 500 pieces we used here 500 into 45, plus this was the only lot which was received before 10th, because next lot was received on 15th. So we have to take balance quantity from this lot only. So 2200 we took from here, 2200 into 50, that if we add this it comes to 1,32,500. It is same as what we calculated with FIFO method. Now on 15th we received another lot of 8,000 and we have to dispatch material here on 21st. I am assuming that we could make only 3,500 pieces from this lot till 21st. So 3,500 into 55 I took from this lot, plus 4,000 into 50 remaining I took from this lot. So 2,200 only I have taken before. So there was availability of 5,800. So I took 4,000 pieces from here. So 4,000 into 50 plus 3,500 into 55. So that is 3,92,500. Mind it, if I am able to make more than 8,000, more than 3,500 numbers here, I will take that quantity because it is LIFO method, last in first out. Whatever quantity I could make from the last lot, I will make and dispatch. And 30th dispatch was 5,000 numbers, and all these 5,000 pieces were to be dispatched from last lot. Since I have already taken 3,500 from this lot, so balance availability with me was 4,500 pieces. So 4,500 pieces into 55 plus 500 pieces I took from the previous lot. So 500 into 50 plus 4,500 into 55, that is 2,72,500. So when we are calculating the direct material cost with LIFO, the cost is coming as 7,97,500. Let's calculate things other than the direct material for cost of goods sold. So the data is in this table. The work in process in the beginning of the month and at the end of the month, as we discussed in the previous slide, and the data for finished good material at the beginning and at the end of the month. We already have discussed it in the previous slide, and the cost is taken from there only. Then we have packing and forwarding cost, that is E and F. This one 30,000 plus 15,000, 45,000 rupees. Direct labor cost G, that is this one is 30,000 rupees. Manufacturing overheads H2L, these are all manufacturing overheads. This is salaries to QC staff, maintenance and store, then depreciation of the equipment, then consumable cost, then rent of the building being used for the production, then cost of the utilities like gases, electricity, water, etc. So all these manufacturing costs, this is put together is 1,13,250. These are all assumed figures. Then if we calculate the cost of goods sold considering FIFO method, then the total material cost is direct labor cost plus direct material cost plus manufacturing overheads plus packing plus freight. So this is direct labor cost is 30,000 rupees. Direct material cost we calculated in our previous slide, and by FIFO method it was coming 7,91,000 rupees. Then manufacturing overheads, as we can see here, 1,13,250. Then the packing rupees 13,000, and the forwarding is of the freight is 15,000 rupees. Total put together is 9,79,250. Now we calculate the cost of goods manufactured, where total material cost will come, and we add the work in process which was available with us in the beginning, and we subtract that from the work in process available with us at the end of the month. So here of course we are considering WIP. So TMC 979,250 was available here. Then the beginning of the month WIP was for 35,000 rupees 750. We added here and subtracted 35,000 rupees, which was WIP at the end of the month. So total COGM, that is cost of good manufactured, was 9,80,000 rupees. Now finally cost of goods sold, COGS. Here we will consider the finished goods inventory. So COGS is COGM plus the finished good inventory at the beginning of the month minus the finished goods inventory at the end of the month. So 9,80,000 plus 20,000 beginning minus at the end of the month 25,500 rupees. So total put together is 9.75 lakhs. So our COGS was 9,75,000 rupees. Now if we consider that we sold the pen at the rate rupees 100 all inclusive, then our selling price was rupees 100, and total revenue we collected was 100 into 16,000 pence we sold. So 100 into 16, that is rupees 16 lakh. Now we can calculate the gross profit and gross profit margin also. So the gross profit margin here would be 16 lakh minus 9.75 multiplied by 100 divided by 16. Total 39.06% was the gross profit margin. I hope I'm clear. And the gross profit, very simple, revenue minus the COGS. 16 lakh minus 9.75, that is 6.25 shall be our gross profit. Let's calculate gross profit margin using different methods of calculating direct material cost. So from the previous slide, we can calculate COGS minus direct material was rupees 1.84 lakhs. And what all it was including? It was including direct labor cost, manufacturing overheads, packing cost, freight cost, and the related material available in WIP and FG at the beginning of the month. The cost of that material. Then cost of the material available in the WIP and FG at the end of the month. This cost has to be reduced. Now when we take FIFO method, the direct material cost was coming 7.91 lakhs. As such, the COGS shall be 1.84 plus 7.91, that is 9.75 lakhs. The gross profit margin as such shall be 16 was our revenue. So revenue minus COGS, 16 minus 9.75 into 100 divided by revenue. So this is 39.06%. And gross profit was simple, 16 minus 9.75. revenue minus COGS, that is 6.25 lakhs. When we calculate the direct material cost by LIFO method, it was coming 7.975 lakhs. COGS as such shall be 1.84, it is constant, plus 7.975, that is equal to 9.81. With this, the gross profit margin shall be 16 revenue minus COGS 9.81 multiply by 100 divided by revenue 16. So it was coming 38.69 lakhs. And the gross profit shall be revenue 16 minus the COGS 9.81. This shall be 6.19 lakhs. Maybe you may remember that the material cost was increased from rupees 50 to rupees 55, and that is why this cost has increased when we are calculating the direct material cost with LIFO method. With weighted average method, the available material was 500, which was at the rate of 45 rupees per piece. So 500 into 45 is 22,500. Then we made two purchases. Purchase one was 8,000 pieces for rupees 50. Then purchase two was 8,000 pieces for rupees 55 per piece. So total cost shall be 8,62,500. The quantity was 8 plus 8 plus 500, that is 16,500. So weighted average cost shall be 8,62,500 divided by 16,500 equals to 52 rupees 27 paisa per piece. So in this case, the cost of 16,000 pieces shall be 52.27 into 16,000 pieces. This will give you figure 8.363 lakhs. So cost of the direct material with WAM method is 8.363 lakhs. And COGS in this case shall be 1.84 constant plus 8.363 lakhs, that is equal to 10.20. Surely gross profit and gross profit margin will reduce. So 16 minus 10.20 into 100 divided by 16. This was coming 36.25% shall be the gross profit margin. And the gross profit shall be 16 minus 10.20, that is 5.80. So with weighted average method, both gross profit margin and gross profit was least. Of course, with the SIM method, we cannot calculate here because it is, we have to consider the specific cost. Let's understand what are the exclusions when we are calculating the cost of goods sold. Generally, these are freight paid for procurement of raw material and shipping of finished good to be included in COGS, but freight paid by distributors for onward delivery should not be included here, and any other freight. Then general administrative cost like salary for administrative staff, rent for administrative building, these costs should not be included. Then R&D cost should not be included here. Interest on the borrowings should not be included. Income tax will not come here. Ending inventory of raw material will not come. I think we have discussed this in our previous slides. Then advertisement cost will not be included when we are calculating cost of goods sold, and sales promotion cost shall also not come when we are calculating cost of goods sold. So this is all in this presentation. Please subscribe my channel if you like it. Thank you.